What's past is prologue. Vapor is setting the stage for a whole new internet, uncovering the electric scooter rage in U.S. cities. Metals are jostling for position to be a part of the next wave of battery technology. Moody suggests that autonomous vehicle startups have inherent disadvantages. IBM announces blockchain-based food safety network widely available across the industry. Food supply chains need an economic incentive to adopt blockchain. And finally, we do 5 good minutes with William Kerr of Edge Logistics, followed by a roundup of third quarter earnings so far. I'm JP.
And I'm Chad.
And we discuss all these issues and more on this week's episode of What the Truck. Oh my God, I can't believe I made it through that intro.
It's a lot. Overall, for our listeners, just know that we are focusing on technology for most of these articles with a brief overview of some highlights of earnings, such as we've heard so far this week. So what you drinking, dare I ask?
Bell's Two Hearted.
Bell's Two Hearted Comfort Beer for JP.
What you got there, Chad?
Shout out to production guru Barry Carpenter, who has set me up with a TrimLine IPA, which, when you've been given a beer, it tastes all the better. Let's just put it that way.
Free beer is
good beer.
Barry, is still in retirement from What the Truck, so we're actually
really silent.
We're actually joined by our newest creative, Layla, is producing this for us in the building, in the room.
All right, great to have you here, Layla, and thanks for bearing with us as we get through all of these headlines. Now, ladies and gentlemen, today we've got a new cadence coming on for this episode. We are gonna hit these headlines, and we're gonna hit them hard, and we're gonna hit them fast, and we're gonna hit them high, and we're gonna hit them low. So the very first one we're going to talk about here.
Yeah, tell us about Vapor. What is this? A blockchain company? Is it a technology company? What are they? How are they making a whole new internet?
Well, today when it comes to companies and experts riding the hype train, it's often associated with blockchain solutions that really aren't ready to solve much of anything.
Right.
Some need to get their crypto tokens all in a row first. Others aren't sure whether they want to be public or private or a little bit of both. And it's not just blockchain solutions. It's everything related to these so-called smart cities. From all the media attention, you might think that these utopian meccas already exist, JP. And the people that inhabit them are leading dream lives among their IoT devices in the babbling brooks of their gig economies. But we see a lot of ambitious plans. We hear a lot of talk. But you know what? This is the thing I like about the kinetic edge stuff. It's like unassumingly, some of the best laid plans are literally being laid down one data center at a time. They're setting them up in these clusters so there's redundancy, and it's just simply going to be this kind of unheralded infrastructure that moves our autonomous vehicles and our final mile delivery applications and all of these IoT solutions, and it gets technical. It's technical stuff. There are things called VLANs that they set up.
Virtual local area networks.
Very nice, and they create these. They basically make them. They're remotely operable, highly redundant, highly secure.
So just to back up and slow down for a second.
Okay.
Vapor, weren't they the company that was starting off building sort of remote and automated air traffic control towers for autonomous drones?
I think.
Kind of essentially solving the problem of if you want to have drone delivery in a city with tall buildings, and most drones now need line of sight communications to be able to navigate. You have to build a network of these places. But it sounds like what you're saying is that they're now diversifying into a whole sort of portfolio of smart city solutions and building these little black boxes that can be all over a city, collecting all manner of data, generating insights, communicating with, passengers of vehicles or corporations or government agencies.
They said they began by considering themselves, they were a vendor of entry infrastructure, and they now consider themselves an edge native co-location company.
Yeah,
So if that's what you were talking about,
and so
they still are working with dealing with drones, which are incredibly complex.
Right, but definitely like moving forward in terms of the regulatory stuff. I mean, if we want to go back to the reauthorization of the FAA bill that just passed, now like I think originally the FAA was opposed to drones. Elaine Chao, the Secretary of Transportation,
that excitement down real fast about a year ago.
Well, they tried to, but then Trump and Chao did a runaround of the FAA, and now Congress is basically forcing the FAA to create regulations for legal commercial drone delivery. So I think that's a huge plus for Vapor. But it's interesting. I mean, it's cool that they're talking about this in terms of like edge computing, which is another like kind of hot topic.
Yeah,
and that's basically the idea that cloud computing was great. It allowed small companies, especially, and individuals, it gave them access to huge amounts of computing power for really cheap. But it did so by centralizing all the computing power in these massive server farms that are being built by Amazon.
Cloud is like a step in this direction. It's like an adjacent possible step, which is creating the decentralization opportunities that they're now creating.
Yeah, exactly. And so, but what we're starting to see with cloud computing is that you need to pay for the server space. You need a lot of fucking bandwidth to move back and forth, between the server and the people who are using the data. And you end up creating these vast data lakes where information is pouring in from all these places all into one thing, and then you have to hire people to figure out what to do with the data.
Yeah.
So the premise of edge computing is you decentralize computing power again. So more of the computing, more of the data collection, more of the aggregation, more of the analysis, more of the recommendations are going to happen on devices on what they call the edge of the internet, which is essentially where the internet interacts with the physical world. So think about like telematics on trucks, smart roads.
And when we talk about decentralization, one of the things, rather than it being up in some like gigantic cloud, this becomes very regionalized, where you have your hardware, your 6 cylindrical chambers, say, of a vapor chamber, and you like have these systems that are regional and that can be accessed much, much more quickly as well. And so it's not only a hardware thing, it is also a software play. They don't really want to specifically call it blockchain, but it is a powerful software that is used alongside. It takes a lot to coordinate all this.
Right. But the idea is that
the amount of data.
The idea is that instead of having a million devices all dumping data into one central server that then has to be analyzed and processed and called up by a human, you have these devices doing all the work themselves and only giving actionable insights to people when it's necessary.
And to me, this is like an unheralded aspect of the future coming up. So we just spent several minutes on that. That was worth the time. But now moving on to the electric scooter rage that's apparently happening in U.S. metropolitan cities. And do you know what's going on with this?
I think that people are these unicorn startups. Bird is one. I can't remember the name of the other one. Vishnu wrote the story, but
Lime.
Bird and Lime. They are. It's basically like a bike sharing or a bike rental thing, except they're electric scooters, and people leave them.
They're awesome. I mean, they were all over the place. I was just down in Atlanta this very week at the Venture Atlanta conference, which is a cool conference, by the way. Venture Atlanta. Check out our coverage of that event. But so there's these random scooters like all over the place, and you can just hop on a Bird scooter and go wherever you want for a couple of bucks and leave the scooter wherever you want. It's amazing. I love it. It's like it's transformative, but apparently
some people don't like it.
Somebody somewhere is getting angry that these
I think
things.
It's mostly, and I've actually heard this from one of my friends who lives in San Francisco. It's mostly like leftists on the West Coast who, they'll like vandalize the scooters, they'll break them, they'll scrawl messages like, Portland is not your corporate playground. Like, I guess it pisses people off. First of all, that everyone's
They say
leaving
that
the
in San Francisco.
Portland's
not your.
No, they
I'm
say
just kidding.
Yeah,
I
okay.
get it.
Yeah. But I think people leave the scooters everywhere, which makes people mad. They drive them on the sidewalks, which offends pedestrians. I don't really. What else contributes to the rage against electric scooters?
Well, apparently they don't always follow the traffic laws. According to the article, too, the companies aren't doing a very good job of modifying whether or not you're 18, or have a driver's license, and so teenagers are kind of a problem with them, and they're trying to do various things of fines, and the companies, it's the Wild West. The companies aren't being super regulated about it, and honestly, I dig it. I'm sorry that there's a problem and pedestrians are mad, but I'm not. I'm a happy pedestrian, and I want to keep disrupting things, and I want to get around easy and in these various
disrupting walking.
Yeah, I suppose so. Disrupting walking for many, many miles in an unfamiliar environment. But so apparently there's problems, but I'm digging the disruption. How about you? How do you feel about it?
I've never ridden on one, and I like walking. But I mean, I don't know. I don't really have.
You like
I
like walking, man. It's nothing against walking.
But I mean, I like walking as a slow way to appreciate a city, as opposed to flitting around on one of these newfangled electric scooters. But I mean, I would be kind of interested to see what happens. I'm thinking especially about. I think was it your article about the sort of crashing, the bursting bubble of. Chinese bike sharing.
No, I think that was Vision.
That was also
Vision.
Yeah. So he's written a lot about like urban mobility, but like,
and those were some legit problems. But we don't have time to cover that right now.
No, we don't have time to cover it. But I just wonder what happens when these scooters start breaking. What happens when there's too many of them? What happens when when they get when they all start piling up in the same sorts of places? How do you redistribute the assets and make them where they're supposed to be to make sure they're being utilized correctly? But none of these companies have to be profitable yet, and so they're all just kind of, like you said, it's the Wild West. So I'll be interested to see where the space goes.
I love it when some IoT solutions actually do improve my life, though, and I'm not just talking in general about some future utopian thing. The digital and the physical world actually coming together. It's just amazing. Metals, buddy. Like what about metals?
Okay, so we can keep this kind of short. It's a little complicated. John Kingston wrote the article on FreightWaves.com. If you guys are interested, he covered strategic metals for a long time at Platts and at the Metals Bulletin.
The chemistry of individual batteries create different strengths and weaknesses. There's a lot of them.
So this is all about emerging battery technology, chemistries that are under development, and what that means for the relative balance between supply and demand for different metals, particularly cobalt and lithium.
And there's also manganese.
Yes, manganese and nickel as well.
It says, he said, while lithium iron phosphate batteries can be preferred for storage in larger vehicles, there's also these trade-offs for cost and density. But overall,
it's interesting. It's complicated because neither the demand nor the supply is going to be elastic. And what I mean by that is battery chemistries take about 10 years to develop and implement.
From the beginning of understanding the nascent technology to getting it up to full production.
It's a very long cycle. Not necessarily particularly responsive to, for example, commodity prices, like how much do these metals actually cost. So you have to spend a lot of money on R&D. It's a risk, that sort of thing. It takes a long time to set up a supply chain. And
for a number
source
of
your
reasons.
metals. And on the demand side, mining infrastructure also takes a very long time to come online. You can't just spin up a cobalt mine because demand is peaking. It takes, hundreds of millions of dollars of investment and many, many years.
And there's a multitude of factors that people are considering, like whether or not, well, first of all, they're constantly trying to improve the technology. So what will the technology sort of discover? That's like an X factor.
Right.
There's also what will on the sort of geopolitical sphere, what's taking place there. Like,
right.
There's a
the
huge,
cobalt in West Africa.
Huge supply of lithium, but it's in Chile, Argentina, China, and Australia. So it's limited in terms of access there. There's also what will be the policy of given governments to, incentivize things. Also, what will just like if some gigantic OEM wants to start like producing and setting in stone what they're going to be using, how will that affect things?
And so right now, weirdly, even though cobalt demand is so it is projected that in the very near future, electric vehicles will need about twice as much cobalt as is being produced worldwide for every industry right now.
Oh, wow.
Yet, we are still in a sort of medium-term oversupply in cobalt. And what that means is if there's an oversupply of cobalt, the price is low, which means that cobalt miners are not building more mines because the price is too low already. And so there's going to be a supply crunch. And I think just the takeaway, and we can move on after this, but the takeaway is that when you have unresponsive supply, you have unresponsive demand factors, you're going to get a very, very turbulent commodities market.
And that is one of our takeaways from the article. Great coverage of that interesting story. Another, it's in some ways.
This is very related. Yeah.
Not a surprising story, but it's certainly related to Moody's, as you wrote, suggests that. Autonomous vehicle startups have inherent disadvantages. No shock here. I guess, maybe it's a shock that like if you were around in 2014 and 15 and expecting this huge thing happen and you invested in the autonomous startups, at this point you might have felt like you were in for a little bit of a rude awakening. There's a lot of ways that technology is developing and a lot of good investments with technology right now. But boy, has autonomous hit some
it's hit a wall.
Some challenges, headwinds.
Yeah. So
tell us about it.
Okay. So Tesla deactivated its autopilot feature
just last month, which is that surprised me to read about. I mean, I know they're having a lot of troubles, but wow.
Yeah. Waymo is getting in near weekly crashes in its Arizona testing locations.
Right.
Uber Freight shut down its autonomous truck project.
And while they're advancing with their...
They're advancing, but it's very, very difficult. It's very hard. Here's the thing. Here's why startups are not... Just boil down why startups aren't good for autonomous vehicles and why they probably won't be able to successfully bring the technology to market. It's because for most technology startups, you release a minimum viable product into the market, you start generating revenue off of it, and then you improve it incrementally, and you improve it really quickly over the next couple of releases. It improves dramatically, and then it's an S curve. At the beginning, it doesn't improve that much. Then it improves a lot. Then it stabilizes, right? Yeah. So if you think about something like a mobile phone, when they first started coming out, they weren't that great. They got really good really rapidly, and now we have like a standard consumer experience that everyone expects. The problem with an autonomous vehicle is you can't release an autonomous vehicle that is kind of shitty. Like it has to be almost perfect for it to be safe at all.
Right.
And like we've even seen from like the accidents that Uber has had, for example, that even the trained paid contractors who are meant to be the safety drivers still have a very difficult time maintaining the proper amount of attention, whether that's keeping their eyes on the road or keeping their hands on the wheel. And so we can't expect consumers to sort of be able to operate a half autonomous vehicle correctly. People don't operate their normal cars the way they're designed to.
And yet, before we get too discouraged, overall, Moody's is still saying that, yes, it's true, by technology standards, this is slow, but the radical evolution of autonomous driving will change over the next 5 years.
Yes.
So it's not a decade.
But the action isn't going to come from startups. It's going to come from very large incumbents, like literally SoftBank dumping billions of dollars into a joint venture between Honda and GM. These are the companies that have the managerial sophistication to orchestrate a bunch of complex technologies together. They have the capital to ride out this really long and unpredictable R&D cycle.
Yeah.
And they can, once they hit the solution, they can manufacture it at scale. And Moody's Moody's, the credit rating agency, really likes the idea of how joint ventures share the risk and spread it across. This is why startups that are trying to do the whole thing by themselves are taking on all of the risk, and they don't, you know what I mean? That's the issue. And so that's why I kind of like said that, the sort of subtext of the Moody's piece, it was really about GM and Honda, but the subtext is that the startups have inherent disadvantages.
What's interesting is IKE, IKE just announced their presence on the startup scene with in a joint venture with a sort of a delivery company, and they made their big press release announcement, and we published it quickly just to get the news out and share the love with them. But then when I followed up with them and asked them some of the specific questions, it's been crickets.
Interesting.
And I wonder if it's because some of these questions are hard to answer at this point. A couple of quick stories that we also wanted to touch on is IBM finally came out and talked about their blockchain-based food safety network.
The Food Trust Network.
Yeah, and not a lot of news here. It's everything that we already knew, what they were doing with Walmart. Other than just they really wanted to emphasize, IBM's messaging is that they really wanted to emphasize that blockchain, they really wanted to separate it from cryptocurrency.
Right.
They really wanted to emphasize the idea of distributing with a decentralized ledger and how this is overall going to be good for blockchain and the future of food safety, specifically in this case. And then, as shortly thereafter, Vishnu covered with an article, "Food supply chains need an economic incentive to adopt blockchain." And this was interesting to me. He talked to an analyst who said, a couple of really important things need to be happening for blockchain to really become widespread. And those were they need financial incentive, and they need an actual auditing. They need an actual auditing process, like where it could be validated in a reliable way, which makes a lot of sense.
Right? Because what good is cryptographically securing immutable records if there's no way to read them? Yeah,
if just some random rather than even if they can not just if they can read them, but if just like Billy Bob out on the farm just puts it into the ledger that yes, this lettuce from Yuma, Arizona is from here. Okay. All right, well, it came from there. At least we know that. But was it still tainted? Or has it been checked? What's the validation process? That makes sense.
And the data entry process, like garbage in, garbage out.
But also, the technology is not the hard part here. The
hard part is
incentivizing companies.
Exactly. Why would you want to expose yourself? Why do you want to take on the liability? Why do you want to basically put all of your internal operations, all of your risk, all of your mistakes in an immutable record that anyone can read? Companies have to have a really powerful economic incentive, like Vishnu says, to become more transparent. I think that obviously Walmart can force its leafy green suppliers to use this technology, which is what they did for other verticals.
And essentially and IBM as well. I mean, in a partnership of two.
But the leverage is coming from Walmart saying if you want us to sell your cabbage, you must use this.
Yeah.
That's a powerful economic incentive.
Yeah.
Another one, I think eventually, and I think Walmart's the second largest grocer in the U.S. after Kroger.
Okay.
So it's that's a big deal. The other economic incentive, I just have a hard time imagining this becoming real, but maybe it will, is consumer expectations about the provenance of the food that they're buying.
I think it's coming.
I mean, are people
We want transparency.
I mean, is my mom who shops at like Kroger and Aldi and Trader Joe's, is she going to does she want to look up every piece of food that she buys on the blockchain? She doesn't even know what the blockchain is.
But see, remember,
you know what I mean?
Now it's not about how the technology works. It's just about using it. And what if you could have a digital display above every single one of your pieces of produce, and you could just be seeing where it came from or something? It's easy. That could be cool, but unless consumers demand it, unless they start preferring food, products with its history on the blockchain over products that don't. Oh, they are. This is coming. This is coming.
I mean, maybe.
I think it is. Just like e-commerce, people have gotten used to getting their goods, overnight and for free. We're gonna want it. We're gonna want to see this. It's all happening, as they say, with blockchain.
I just imagine
and visibility.
the grocery run of the future. Me calling texting an order to the shipped driver and being like, "Hey, can you make sure that the apples that you pick up have never been above 75 degrees?" The Salinas Valley would be ideal.
You don't have to actually ask that of your shipped driver. You just can see it all documented on your order. Yeah, you're going to prefer the stuff that's traced rather than the stuff that's not.
All right.
I'm being the advocate here for blockchain happening soon. All right, and now we have 5 good minutes.
With William Kerr, president of Edge Logistics, we're doing a flashback back to the McLeod User Conference in Birmingham.
And here's one of our more interesting interviews. Take it away. All right, well, hey, welcome back to another exciting 5 Good Minutes segment. We are coming live to you from the McLeod UC 2018, and we are visited by none other than William Kerr of Edge Logistics.
The president of Edge Logistics, in fact.
Whoa.
Thanks for stopping by, William.
Are you ready to play 5 Good Minutes?
I am. Thanks for having me.
All right. Ready or not, here we go.
So just tell us a little bit about what Edge Logistics does and what role you think technology plays in broker productivity.
Well, we're a full truckload broker for the most part, and the technology has really allowed our individual brokers to accomplish more and more and more every year. When I first started in the business, 10 loads a day, 11 loads a day was a pretty great number for a carrier rep to execute,
right.
To pick up and deliver each day. And now we're seeing 20, 25. Some of my top brokers are doing 50 plus loads a day.
Wow.
And the main reason for that is the technology is you're able to stay organized and eliminate time wasting behaviors.
Awesome. Can you talk a little bit about how Edge chose to go with McLeod's TMS or with Power Broker? What was that decision process like, and how has it played out?
Well, we first started on Keypoint TMS, which is a DAT product, and that was really great when we were very small. But once we started having multiple offices, working off the same load board, and multiple salespeople, running different accounts, it became somewhat unmanageable. And McLeod does a great job of allowing everybody to work in the system and having communication occur in the system rather than having to use emails, phone calls, and that sort of thing. within the company. So that was the main reason. The reason why we chose it was more of looking at some of their success stories in the space, like AFN and Global Trans and Load Delivered, and some other great brokers who have come up in the last 10 years or so, and really had McLeod be a big part of that.
Right. You were at the Power Broker update session. What are you guys like looking for? What are you guys really anticipating? What moves the needle in terms of additional features for Edge?
The biggest thing is eliminating repetitive processes. We want to do everything once. We want to do it correctly. We want to have less errors and less multiple people touching the same thing. Whether that's dispatching, whether that's quoting, whether that's billing. All of these streamlined processes that are coming out with, being able to do multiple aspects of the system on one screen and not having to open windows to make edits and that sort of thing are really going to help. We only have a certain amount of time in the day, and we could book as much freight as possible in that amount of time. But anything we could do to save a second here, a second there, really helps over the course of a month, a year, whatever.
One of the things we're seeing with some of the AI stuff is an interesting thing is it's still about relationships. It's still a relationship business. Do you see like the improvements in communication with the stuff you guys are using? How does that work one way or the other?
Well, ultimately, it just comes down to picking up and delivering loads on time. And I think we could do, if you pick up and deliver on time, then communication, it kind of speaks for itself. Communication is really important in the event of, something going wrong. But for the most part, our customers just want it to get done. And we find that, if a customer gives you one order and you pick it up and deliver it on time, we're going to give you 2 more. You get those ones done, they're going to give you 10 more. Get those ones done, they'll give you 100 more. And it's just all about your service levels. And however we get there, however we get it done, it is, the technology, talent, communication, customer service, all those things come into play. But really what it comes down to is just performance.
The bottom line.
Yeah.
Mm-hmm. One more question. This is kind of on my mind because we just saw John Larkin from Stifel talking about trends in transportation. But what do you what does the freight market look like from your guys' perspective right now? What are the challenges for brokerage, moving into the back half of 2018?
We're seeing a very positive outlook for new business. It's never been this manageable to get in front of new customers. I think everybody's looking for a new solution. Everybody wants to see what everybody else is doing, and I think that a lot of that has swung the broker's way lately through great success stories, through major acquisitions, through the emergence of new technology, and all these companies in Chicago and other places really growing rapidly. And
awesome, dude.
Well said.
You snuck in there right.
Oh, I got it. All right. Yeah.
Congratulations.
Thank you.
Bing, bing, bing. All right. Great to have you here. Good job, man.
Yeah, thanks a lot.
No problem.
Okay, and now we are back to cover the scintillating earnings calls of the week.
Chad hates talking about earnings calls.
I mean, they provide insights for us.
Okay, yeah. I mean, I think we can start off with CSX. They did their call Tuesday night after trading closed. Jim Foote. This was the railroad that Hunter Harrison was running when he died in December of 2017. Jim Foote is running it now. Still sort of in middle innings of implementing precision scheduled railroading, but they brought the OR down to 58.7%. Expenses, cutting expenses down. I think their Foote said that CSX's earnings were boosted by strong coal demand, and that's really the export market for thermal coal, not necessarily metallurgical coal, but coal for burning and generating electricity. The other thing that I would notice is that the intermodal growth is anemic. They're still working on that network. The service is really bad. I don't think Foot is particularly interested in intermodal volumes, from what we've heard from recent comments he's made. And, I think the on-time delivery percentage for intermodal is like 64%. And if you think about intermodal as the kind of railroad freight that competes with truckload, and truckload is, high, 98, 99% on time, like I don't know how much I don't know how much CSX cares about intermodal. I'm not convinced.
But they're saying that they want to. That's part of the narrative.
They're
right?
saying
that's
that they want to grow it.
They're wanting to take their slice of the pie back
from truckers. Yeah, and they say that, but they're not.
Okay.
They're not doing it.
Okay, so JB Hunt's earnings beat estimates thanks to better brokerage and truckload businesses. The Arkansas-based company reported a net income of $131 million for the third quarter, a 31% rise from a year earlier. Is there any but to this story? Is it
I think
all good news?
When you talk about eastbound intermodal volumes from the West Coast, they had some interesting color on the shape of peaks of the summer surge. It came a lot earlier this year. It was sort of bunched up in the front half, dropped off in September.
Yeah.
August and September, started coming back again end of September. That was pretty interesting. We continue to see how the increased pressure on shippers and transportation companies and the strains on the supply chain are kind of shaping and massaging those surges in freight. To me, that's pretty interesting.
Right. The drivers' wages are up 18% for them, which is higher than what we had seen from the Goldman Sachs.
Yeah. So high,
12%.
Right. Yeah.
But it's aiming to recoup those costs, as you're basically saying, through massaging these new shipper contracts.
That and they have a really sweet deal with BNSF where they have a revenue sharing arrangement with BNSF, but they essentially get to name their own price. It's this joint service agreement. They get to name their own price. They get the first pick of capacity and so BNSF services the West Coast ports. Really important to getting Asian exports into the U.S. It's interesting. I mean, they have this joint service agreement. It's been contentious, though, and they've gotten several lawsuits over it. I think JB Hunt just took like an $18 million hit paying back some of the money it owed BNSF for the past 4 years of this deal. But that's one way that JB Hunt's able to control its costs is by dumping stuff onto the railroad for really cheap. Maybe that's how they can afford to pay their drivers more than the industry average.
Interesting. What do you think about Trump's tariffs wrecking Wabash National's earnings?
This is really interesting to me. Wabash National is the large. I don't know if they're I think they're the largest manufacturer of semi-trailers. They're the only publicly traded manufacturer of semi-trailers in the U.S. And they are very exposed to the cost of steel and aluminum, which is what they build trailers out of. Obviously, we know that Trump put a 10% tariff on steel and a 25% tariff on aluminum, driving up the cost of those materials. Now, what's interesting is that Wabash hedges about 70% of its raw material costs by trading metals futures contracts. And with the other 30%, what they do is they pass it down to their customers. But it's kind of on a lag. It's like they do monthly adjustments, but they're getting their money a month later. In other words, they're making up their losses a month later, which works once the price stabilizes. If the price continues to go up, they see really bad pressure on their margins. And the takeaway from this is that even though trailer orders, for example, in September were 135% year over year. Like they're
doing well in spite of some of these headwinds. It seems like with a strong overall market demand for their products.
Well, this is the issue. They should be having their best year ever. They, trailer orders are destroying records
Right.
by like, double digit percentages. But yet Wabash National's net earnings have been cut in half from where they were a year ago because of input costs. But one of the other things that's really hurting them is that in this economy we have very low unemployment. They've had a difficult time sourcing workers to build trailers in their plants. Therefore, they've had to pay more overtime than they wanted to, which is driving up also labor costs. And so there's a couple of different headwinds they have, and it's almost like if you can't make really, really good money in a year when everyone is desperate to acquire as many of your products as they possibly can get their hands on, something is kind of wrong with your company. Like their net earnings are half of what they were last year, and yet the demand for their product is double of what it was last year.
As you said from the beginning, they're very exposed to the raw material tariffs.
Right, and we actually published a chart that compared the price of U.S. coil steel futures contracts against Wabash National's stock price. And you can see very clearly as the cost of steel goes up that their company becomes less valuable.
Well, finally, you wrote about brokerages navigating, sort of quarter four volatility, and you did kind of an in-depth report with Arrive Logistics. What's your takeaway here?
Yeah, shout out to Arrive. It was really great working with their team on this piece. But basically, a couple quick takeaways. One is that collaborative relationships between shippers and 3PLs are becoming vital to moving product at reasonable prices in Q4. Secondly, in terms of market conditions, the deterioration of spot rates against contract rates. So right now, spot rates for trucking are at about a 23 cents per mile discount to contract rates. That's giving brokers a big opportunity, because if you think about what brokers do, especially if they have large contracted accounts, they're selling capacity at contract rates, and then they're turning around and buying capacity at spot rates. And when the spot rates are falling relative to contract, they're essentially being able to sell high and buy low. And so the more that spread widens, the more potential margin they get, and the easier it is to find those spot trucks. So, it's a big deal for them. We'll see what happens to rates as we really get into holiday shipping season, next month, especially. But right now, I think most brokerages are sitting pretty.
Okay, and that is the takeaways from this week's roundup of headlines. As always, we go into more detail about each of the topics we've talked about today on our website, FreightWaves.com. We will continue to publish this podcast weekly, so be sure to subscribe to What the Truck on Apple Podcasts, Google Play, Stitcher, and SoundCloud. Also, make sure to leave us a review to let us know what you think of our new podcast.
And if you're interested in freight economics and finance, come to our Market Waves conference at the Gaylord Texan Resort and Convention Center in Grapevine, Texas, this November. Visit marketwaves18.com to learn more about this event.
That'll do it for today. Thanks for tuning in, and we will see you next week on What the Truck.